Michael Burry. The name may not ring a bell for everyone, but on Wall Street, he's a legend. Remember the 2008 housing crisis? Burry saw it coming. He bet against the housing market and made a fortune. His story, featured in the book and movie The Big Short, is a testament to his sharp intellect and ability to see what others miss. Burry's not just a one-hit wonder. He's known for his deep dives into economic data, often spotting trends years before they become mainstream. He's a contrarian investor, meaning he often goes against the grain, betting against the crowd. And more often than not, he's right. To understand Burry's warning, we need to grasp the concept of interest rates. Simply put, it's the cost of borrowing money. When interest rates are low, borrowing is cheap, encouraging spending and boosting the economy.
But when rates rise, borrowing becomes expensive, potentially slowing down economic growth. Burry sees several factors pushing interest rates higher. First, inflation. Prices of goods and services have been rising at their fastest pace in decades, eroding consumer purchasing power. The Consumer Price Index, or CPI, a key measure of inflation, has been stubbornly high, forcing the Federal Reserve to take action. Second, the Fed's response to inflation. To combat rising prices, the Fed has begun raising interest rates and slowing down its bond buying program, which was injecting money into the economy. This tightening of monetary policy is intended to cool down the economy and tame inflation. However, Burry believes the Fed is behind the curve. He argues that they've misjudged the severity of inflation and will need to raise rates much higher than anticipated to bring it under control. This aggressive tightening, he warns, could trigger a recession.
Inflation is the silent thief in your wallet. It's the gradual increase in the prices of goods and services, making your money worth less over time. Remember when a gallon of gas cost $2? Those days seem like a distant memory. From groceries to gas to housing, prices have been steadily climbing, putting a strain on household budgets. There are several culprits behind the current surge in inflation. The COVID-19 pandemic disrupted supply chains, leading to shortages and higher prices. Government stimulus checks, while well-intentioned, injected trillions of dollars into the economy, increasing demand and further fueling inflation. And the war in Ukraine has sent energy prices soaring, adding to the inflationary pressures. The Fed initially dismissed inflation as transitory, arguing that it would fade as the pandemic subsided. However, they've since acknowledged that inflation is more persistent and have begun taking steps to address it. The question is, will it be enough? The Federal Reserve, or the Fed, is the central bank of the United States. It's responsible for maintaining the stability of the financial system and promoting economic growth. One of its key tools is setting interest rates. When the Fed lowers interest rates, it makes borrowing cheaper, encouraging businesses to invest and consumers to spend. This stimulates economic activity. Conversely, when the Fed raises interest rates, borrowing becomes more expensive, which can slow down the economy. The Fed walks a tightrope, trying to balance economic growth with price stability. If they raise rates too slowly, inflation could spiral out of control. But if they raise rates too quickly, they risk triggering a recession. Currently, the Fed is in the process of tightening monetary policy, meaning they're raising interest rates and reducing their balance sheet, selling off bonds they purchased during the pandemic. This is their way of trying to cool down the economy and bring inflation under control. However, as Michael Burry points out, they may be behind the curve and need to act more aggressively.
Market déjà vu. Remember the 2008 housing crisis? It was triggered by a combination of low interest rates, loose lending standards, and speculation in the housing market. Many people took out mortgages they couldn't afford, leading to a wave of defaults and foreclosures when the housing bubble burst. Fast forward to today, and some experts see eerie similarities. Years of low interest rates have fueled a surge in housing prices. In many cities, it's a seller's market, with bidding wars and homes selling for well above asking price. While lending standards are tighter than they were in the early 2000s, there are concerns about rising household debt and affordability.
Michael Burry has been particularly vocal about his concerns about the housing market. He believes that rising interest rates could lead to a decline in housing prices, potentially triggering a wave of defaults and another financial crisis. While it's too early to say if his predictions will come true, it's a risk that investors should be aware of.
Section 6. the ripple effect: stocks, bonds, and more. The impact of rising interest rates extends far beyond the housing market. It affects all financial assets, including stocks, bonds, and even cryptocurrencies. When interest rates rise, it becomes more expensive for companies to borrow money, potentially impacting their profits. This can lead to a decline in stock prices. Bonds, which are essentially loans to governments or corporations, are also sensitive to interest rate changes. When interest rates rise, the value of existing bonds typically falls. This is because investors can buy new bonds with higher interest payments, making older bonds less attractive. Cryptocurrencies, while often touted as an inflation hedge, have also shown to be correlated with the stock market. When the market falls, cryptocurrencies tend to follow. This highlights the interconnectedness of financial markets and the importance of understanding how different asset classes react to changes in interest rates.
Section 7. Riding the Wave Investor Strategies. So how can investors navigate this uncertain environment of rising interest rates? The key is to stay informed, be prepared, and adjust your investment strategy accordingly. Here are a few things to consider. Diversification. Don't put all your eggs in one basket. Spread your investments across different asset classes such as stocks, bonds, real estate, and commodities. This can help mitigate losses if one asset class underperforms. Value investing. Consider investing in undervalued companies with strong fundamentals. These companies may be better positioned to weather economic downturns. Cash is king. Holding some cash can be beneficial during times of market volatility. It allows you to take advantage of buying opportunities when prices dip. Seek professional advice. If you're unsure about how to adjust your portfolio, consider consulting with a financial advisor. They can help you create a personalized investment plan based on your risk tolerance and financial goals.
Section 8. Gold, a safe haven. Gold has long been considered a safe haven asset, a refuge for investors during times of economic uncertainty. Its value tends to increase when there's fear of inflation or a decline in the value of paper currencies. This is because gold is a physical asset with limited supply, making it less susceptible to government manipulation. During the 2008 financial crisis, for example, the price of gold soared as investors sought safety. However, it's important to note that gold's performance can be unpredictable. It doesn't generate any income, and its price can fluctuate significantly in the short term. If you're considering investing in gold, it's important to do your research and understand the risks involved. You can invest in gold through various means, such as buying physical gold bars or coins, investing in gold ETFs, or buying stock in gold mining companies. Congratulations for making it this far. Click the subscription and notification buttons. Real estate has long been considered a solid investment, offering the potential for appreciation, rental income, and tax advantages. However, as with any investment, there are risks involved, especially in a rising interest rate environment. As mentioned earlier, rising interest rates can lead to a decline in housing prices. This is because higher mortgage rates make it more expensive for people to buy homes, potentially reducing demand and putting downward pressure on prices. If you're considering investing in real estate, it's crucial to do your due diligence. Research the local market, factor in the potential impact of rising interest rates, and make sure you're comfortable with the risks involved. It's also essential to have a solid financial plan and avoid over-leveraging yourself.
Michael Burry's warnings about interest rates and the economy are not meant to scare investors, but rather to encourage preparedness. The key takeaway is not to panic, but to be proactive. Understand the potential risks and adjust your investment strategy accordingly. This is not the time to be complacent. Stay informed about economic developments, monitor your investments closely, and be prepared to make adjustments as needed. Remember, knowledge is power, and in the world of investing, staying informed can make all the difference. The future is uncertain, but by being prepared and making informed decisions, you can navigate the challenges and capitalize on the opportunities that lie ahead.
In today's complex financial landscape, financial literacy is more important than ever. It's no longer enough to simply rely on others to manage your money. You need to take control of your financial future by educating yourself about personal finance, investing, and the economy. There are countless resources available to help you improve your financial literacy. Read books, articles, and blogs. Listen to podcasts and watch videos. Attend seminars and webinars. The more you learn, the better equipped you'll be to make sound financial decisions. Financial literacy is not just about making money, it's about achieving your financial goals, whether it's buying a home, retiring comfortably, or leaving a legacy for your loved ones. By investing in your financial education, you're investing in your future. The economy is constantly evolving, presenting both challenges and opportunities for investors. While Michael Burry's warnings about interest rates should not be ignored, it's essential to remember that no one can predict the future with certainty. The key is to stay informed, be prepared, and adjust your investment strategy as needed. By diversifying your portfolio, considering value investing, holding some cash, and seeking professional advice when necessary, you can position yourself to weather economic storms and achieve your financial goals. The future awaits, and by embracing financial literacy and making informed decisions, you can face it with confidence and achieve financial success. I want to read your thoughts in the comment section. Thank you for watching. See you again next week.